Namaste to one and all. Welcome to my channel. Today's topic is banking and credit. When we say about the banking and credit, just we tell about something, some details about the money. Before the introduction of money, we had the barter system where goods and services were exchanged for goods and services. For example, a person wants to buy cow, and the same person wants to sell food grains. He has to find out a person who needs cow at the same time who is ready to buy food grains. Maybe 5 bags of paddy is equal to, or 5 bags of rice is equal to 1 cow, like that. So getting rice and selling cow, it can be done that is between two persons who are ready to buy the same thing what he is going to sell, and the person who is buying that cow should ready to sell the rice. This type of selling and buying by each other, this is known as double coincidence of wants. And earlier people used to collect or keep their wealth in form of cattle, food grains, later gold coins, silver coins, etc. Even salt also kept as a valuable thing. And this I told you about the double coincidence of wants. Barter system, I told you the barter system should have the double coincidence of wants. Only then the exchange could possible, exchanging goods and services for exchanging goods and services. That is what a person is willing to sell and what a person wants to buy. The same thing should be done by in the other way. What he is selling, the same thing should be sold by the another person, and what he needs, that should be sold. That should be what he is selling. First person is selling that commodity should be purchased by the second person. So this is double coincidence of wants. But the major difficulty challenge of the barter system was this double coincidence of wants, and later came to know that the absence of double coincidence of wants, and it was not fulfilling it as a medium of exchange. It was not fulfilling as a store of value, and the future payment was also not possible, and measure of value was also not possible because of the absence of double coincidence of wants, absence of store of value, absence of measure of value, absence of future payment. The people wanted to get a new source of to show the denomination, or to show that this is a money, this is a wealth a person is having. So there comes the introduction of money, that is coins and notes. This we call it as currency. Because of the introduction of currency, we can see later the modern world is dealing with the banks. Banks is dealing with the money. What the bank is, when the bank is selling money, we call it as lending. And when the bank is buying money, we call it as borrowing. When the bank is so the term is, when the person is borrowing money, person needs money, that is borrowing. When the bank is selling money, that is lending. So lending and borrowing. And what about the money is concerned, the bank is concerned, that is as because of the introduction of coins and currency notes, it fulfills no need of double coincidence of wants. That means it fulfills the medium of exchange. It is coins and currency notes, full paper notes, that is currency. Currency fulfills medium of exchange. It is easier to store, that is it fulfills the storage, and it acts as a medium of exchange. It is easier to store the currency, that is currency, I told you, paper notes and coins. And for the future payment also, it become easier. There comes the banks. Banks are lending, and banks are accepting deposits. And it is also dealing with a check, draft, order, or otherwise check. and accepting deposits from public and giving loans. And these are the major functions of commercial banks. At the same time, several other utility services are rendered by the banks. Locker surveys are there, and nowadays, that through the banks, a lot of things the people can do. And so here, regarding when a bank is accepting deposits, the bank should give a particular rate of interest to the people. And when the public borrows money from the bank will charge a rate of interest. The charging rate of interest for the loan is higher than the rate of interest given to the public for their deposit. This difference is the profit of the bank. And when a depositor is how the bank is accepting the deposits, that is opening an account in the name of the depositor. The bank gives an account number to the depositor. Whenever the depositor wants to deposit money again, or he or she has to mention the account number so that the bank will keep the money in the account. If the depositor withdraws money from his or her account, the bank deducts the money from the depositor's account. On other hand, bank gives interest on certain types of deposits of the public. Note that the bank issues checkbooks to its depositors. Checks are used by the depositors to withdraw money from the bank. And nowadays we know several, the e-banking is there, ATM cards are there, ATM card as a debit card and credit cards also there, and several other through several means, that is Google Pay is there. So several other techniques of money exchange can be done through banks. And giving loans, the bank gives loans to public who want to borrow and who has the capability to repay the loan amount in future. So to whom the bank is giving loans, the people who are in need of the money and who is having the capacity or the capability to repay that loan amount in future. And why the people borrow money? In order to buy certain things, that is car, television, refrigerator, washing machine, etc., or to do some business. And for the construction of house also, or buying a house also, the people used to avail loan. Then keeping valuable materials, the bank is keeping the locker facilities, gives valuable things for the people such as jewelry, property, documents, etc. Normally people want to keep valuables in safe custody, which is provided by the bank in the form of locker facility. So three major functions we have seen regarding the banks. Then we can see the important concept of bank is credit. It is defined as a claim to receive payment. When a bank gives loans to the people, then the bank becomes a lender, and the person who takes loan from the bank is called the borrower. The bank gives loan today. It also makes arrangements to recover the same from the person in future. This means that the bank can claim the money from the borrower in future. Accordingly, the bank is able to expand its deposits. Yes, how the bank is expanding its deposits? When the bank is getting a deposit of 5 lakh rupee, the bank is able to give loans more than 5 lakh rupees. That how it happens, that is known as a credit creation. So one example is being given here. With that example, we can see what about the process of credit creation. And here we know when the bank is accepting deposits from the people, the bank, anytime the depositors can approach the bank for the to get back to withdraw the money from the bank. So here, from common experience, it is we can see that the depositors will not withdraw the whole amount. The depositors, smaller amounts they used to withdraw. But to make any time, suppose the people can approach the bank, and so bank always keeps some fraction of its total deposit in the form of cash, from which it keeps giving money to people who come to withdraw it. That means, that is when it is according to the instruction of the central bank, will ask the commercial banks to keep a particular percentage of money along with the bank. Only the remaining should be given to the people as a loans. Suppose the bank is getting 100 rupee. Suppose the bank is getting 100 rupee. From this 100 rupee, suppose 10% should be kept by the bank, and 90 rupee, suppose 100 rupee, 10 rupees should be kept by the bank in their lockers or in their shelf or in their cupboard, and the rest only can be given as a loan. So 90 rupee can be given as a loan. If the 10% should be kept by the bank, this 10% we call it as cash reserve ratio. What is the amount the bank should be kept in their shelf? That is, it is a precaution that the entire deposit should not be given as a loan. So the cash amount is kept as a reserve for making cash payments to payments to the public who come to the bank to withdraw money. We call the fraction of the total deposit to be kept in the form of cash as cash reserve ratio. Once the bank calculates the amount to be kept as cash on the base of cash reserve ratio, it deducts the amount from the total deposit and uses the rest of the amount to give loans to borrowers. Suppose how many 100 rupee they are getting, how many lakhs of rupee they are getting, the fraction should be kept as reserve according to the cash reserve ratio. Now I didn't go through what is a reserve cash reserve ratio. I think it was about 4.25 or like that. Sorry, I didn't go through now. And in this study material, it is written about the 20% cash reserve ratio. And here we are assuming that there is only one bank. For easily to understand easily what is meant by credit creation, an example has been given. A person called A deposits 100 in the bank, and as a result the bank's deposit increases by rupees 100. As per rule, the bank should keep 20%. This now it is not 20%. Anyway, for the sake of this example, we can say 20% of 100 as cash. This comes out to be 10 rupees 20. So the bank keeps 20 rupee as reserve, 20 rupee to make cash payment, 20 rupee as reserves, and the rest 80 rupee will be given as loan to the public. And we are assuming there is only one bank, and a person called B approaches the bank to take the loan of rupees 80, and after the bank gives again 20% of 80 is kept by the bank, and the rest of the amount is given as a loan. So, no, this 80 rupee here example is that the approaches the bank and deposits this 80 rupee. As bank gives this loans, it can claim amount from B in future. This means that giving loan to B, the bank can create another deposit of rupees 80. So, another person B is approaching the bank and asking for loan. And when the bank is asking for loan, the first person A deposits 100 rupee. By giving loan to B, the bank is able to claim rupees 80. So after 2 steps, the bank has a total deposit of 180. Then another person called C wants a loan from the bank. How much amount of money the bank can give? So first 100 rupee person A has deposited. Then person B had a loan of it, approached the bank for loan. So 100 rupees, 20% kept by the bank, and 80 rupees being given to the person B. So 100 plus 80, now the total deposit is 180. Because 80 rupees given to the person B as a loan, even though it is a loan, there also the bank will make that Mr. B is having an account of rupees 80, like that. So earlier 100 rupee by Mr. A, the real deposit. Next, by credit creation, Mr. B is getting 80 rupee as a loan. How the 80 rupees as a loan? That is, the bank will make him as a depositor, and from the deposits he with the help of check he is withdrawing money. So the total amount is now 180, but really only 100 rupees is in the bank as money. Then another person called C wants a loan from the bank. Now you know that the bank is approaching. Again, we are telling that in the previous step, we saw the bank could increase the deposit by rupees 80 by claiming the amount from B. As per rule, it has to keep 20% of 80 as cash. Now, 20% of 80. Here we can see that another person is depositing in the bank or asking the loan, and 20% of 80 as cash before giving further loan to anybody. So again, 20% of 80, 16 rupee is kept by the bank, and so the bank will now keep 16 rupee as cash and give the rest of the amount as loan. So 64. Now 100 plus 80 plus 64. Now you know the total amount the bank is giving is 244, or 100 plus 80 plus 64. Yes, that is the same thing I told you. Yes, like that. And so the chain will continue for some time, but when it will come to an end, that in each round the bank keeps 20% of increase in deposit as cash and cash. You also know that the bank started with an increase in its deposit by rupees 100 in step 1. So the process of credit creation or increase in deposits will come to an end when 20% of deposits of each and every round taken together becomes 100 itself. Then how we'll find out the 20% of what amount is 100? The answer is 20. The answer is 20% of 500 is 100. So 20% of 500 is 100 means we have to divide, that is the bank deposit by 100, and the cash reserve ratio is 20 by 100. That is we can see that 20 is a cash reserve and 100 is the original deposit. And so you can see here is 1 by 5, like that. So this means that in our present example, with initial increase of the bank deposit by 100 and cash reserve ratio is 20, so the total credit creation will be rupees 500. Yes, this how it 500, that is 100 into 1 by 5. That is total amount is 500. So 500 is equal to 100 into 1 by 20%. That is equal to 100 into 1 by 5 is equal to 100 into 5. That is accordingly we can give the following formula for credit creation. So total credit created is initial increase in deposit, that is 100, and 1 by cash reserve ratio. 1 by cash reserve ratio. Accordingly we will get to the formula that 1 by 20%. 1 by 20%. So we will get that we will get that 500. So this is how. So understand that 20%, easily you can understand another way. 20% divided by 100, you will get 1 by 5. So 1 by 100 into initial deposit is 100 into 1 by 5. What is a cash reserve ratio? Cash reserve ratio is 1 by 5. 1 by 5, how we will get? We will get what is the percentage of cash reserve divided by deposit is 1 by 5. So 100 into 1 by 5. 100 into 1 by 5, we will get 500. This way we can, with every, suppose 100 is the amount, the bank can create 500 rupee. That much credit can be created without new coins and currency notes. That is the importance of credit creation money. That means that in the economy, the total money supplied in the economy is more than that the real money issued by the government. So remember another important point, since the bank deposit divided into 20% is cash and the rest of the loan through various steps, the total deposit of rupees 500 can be divided in the following manner. Cash reserve is equal to 20% of 500 is equal to 100. So the loan amount is 500 minus 100 is equal to 400. Yes. Yes, I want to show you, this is the table. You will easily understand. First have 100, 20, then loan 80%. So, yes, this is the person A, and person B is getting 80% loan, and the loan amount from that 80, that is 64. Then C, then 64, he is getting the increase in deposit 64, and 20% is 64. You can say 51 point is 20% is 64 is 12.8. 12.64 minus 12.8, you will get 51.2. Then again 51.2, that it's 20% is 10.24. So 51.2 minus 10.24, you will get 40.996. Then again 40.96 in minus 8.19, that is 20%. 40.96 is 8.19, that way. So that way, when we add it, we can see that the loan created by the bank is 400, and increase in deposit is 500, and really the cash reserve ratio is, cash reserve kept by the bank is 100. So 500 minus 100 is equal to 400. So remember that in the process of credit creation, two types of deposits are recorded. First one is called the primary deposit. Primary deposit is 100 is a primary deposit, and primary deposit is the initial increase in the bank deposit resulted when the bank receives a new deposit from public. When in our example given above, primary deposit is 100, is primary deposit is 100, deposit by person A. In the beginning. And the second type of deposit is called the secondary deposit. The deposits created due to the loans given by the bank in each round are called secondary deposits. Credit creation is possible due to the increase in the secondary deposit. So what is the credit creation capacity of the bank? The credit creation capacity of the bank depends on the cash reserve ratio. CRR is, this is a CRR, cash reserve ratio. Is if the cash reserve ratio is higher, then the bank has to keep more cash to keep payments to public, and accordingly they have to keep more cash. If the cash reserve ratio is higher, they have to keep more cash in the bank, and less only they can give to the public. Fewer amounts will be available for giving loans. So less credit will be created. Credit creation will be higher if the cash reserve ratio is lower. In our example, the total credit was 500, given that the cash reserve ratio was 20% and the initial increase in deposits was 100. Now, the increase the cash reserve ratio to 10%. If it is 10%, the result will be, the credit created will be 1000. So like that it comes. So these are the, and then various types of banks. That is Reserve Bank of India, that is our central bank. Then commercial banks, cooperative banks, development banks. Reserve Bank of India, its headquarters in Mumbai. It is controlling our banks, and the paper currency various denominations are issued by the central bank. Yes. Then commercial banks also, different commercial banks. Really, the central bank is not issuing loans and deposits. Really, the commercial banks are doing all these things. Central bank is controlling. The Reserve Bank of India is controlling the commercial banks through the cash reserve ratio, through the bank rate. That is, bank rate means the rate of interest. Through open market operations, etc. And there are some commercial banks which are under the public sector. For example, State Bank of India, SBI, Punjab National Bank, PNB, the Bank of India, BOI, the Indian Bank, then Canara Bank, Bank of Baroda, etc. The Canara Bank. Yes. Then there are other commercial banks which are under private sector, ICICI, Indus Credit for Investment Credit, of Indian Bank, then S Bank, HDFC Bank, etc. These are private banks. The aim of commercial bank is to earn profit by charging rate of interest on loans and fees for various services such as issuing draft, transferring money, etc. What is the difference between check and draft? Check is issued by the bank to the depositor. The depositor can use a check to withdraw money from the bank. Then the draft is a check issued by one bank, and it is to another bank. The check used by a bank to issue the money in the name of another bank, that is draft. In check, depositor and one bank. In draft, in between the transactions between two banks through a check, that is draft. And transferring money, and yes, there are several various methods for transferring money. Then the cooperative banks for agriculture purpose and non-agriculture purpose in rural urban area. In rural areas, cooperative banks provide credit for farming, cattle, fishery, etc. And in urban area, the cooperative banks provide credit for self-employment activities, small-scale industry, purchase of durable goods such as television, refrigerator, etc. and personal finance. And here, the cooperative banks also give loans to the public for their consumption purpose for the purchase of goods in rural area. The major, what is their focus, that is written there. Then examples of cooperative banks are state cooperative banks, primary agriculture credit societies, urban cooperative banks, land development banks, district central cooperative banks. These banks may bear different names in different states and areas than development banks are. To achieve economic development for a country, investment in industries and infrastructure is required. To make such things possible, there are development banks in India. These banks provide credit for a longer period to private business companies and public sector units who want to establish industries and create infrastructure. Some example of development banks are Industrial Development Bank of India, IBA, is Industrial Development Bank of India, Industrial Finance Corporation of India, State Finance Corporation of India. So IDB, then IFC and ISF, that is SFC, IFC, then SFC, and yes, these are the things regarding this chapter. As it is the need of the hour, I have done this quickly. All the best, those who are writing exam day after tomorrow. Thank you.